Greetings, fellow traders. I'm Dylan, a research strategist at Pepperstone, presenting you with the latest weekly update on as good as gold. So actually, after the V-shaped reversal against the US dollar last week, the upward momentum holds well with buyers dominating the gold market. The strong price movement is most obviously observed in gold against US dollar, since the greenback has been almost the weakest currency in G10 over the past 5 days, while the trend is fairly modest in Japanese yen, British pound, and other better performers. Despite gold's 1.7% appreciation in US dollar terms, platinum has outperformed with a 6.5% gain over the past week. Now, if we look at the daily chart of gold against US dollar, after briefly touching 1934 last Monday as the 38.2% Fibonacci retracement level of the October rally, which is also the 200-day moving average, the trend was reversed to the upside, breaching 1962 as the 23.6% level, then the 1981 resistance zone, one after another without much hesitation. Afterwards, gold broke 2000 for the first time since October 31st yesterday, with the highest intraday price of 2007.5, only $2 lower than the local high in late last month. It is currently being traded at around 2000, and if the momentum persists, we can see 2048 as the first resistance, testified in mid-April and also early May, if not considering 2009 as the previous high. And if 2048 fails to prevent buyers from entering the market, the March 2022 and May 2023 high at 2070 is another potential sell-off level. Then it comes to 2085, the 38.5% Fibonacci projection level to the upside based on the October rally. Although less likely to happen, 1934 serves as support to the downside. As for the reasons behind this, I reckon the fact that the market has priced out the possibility of another rate hike in the US is the essential driving force. The labor market is cooling with lower than expected non-farm payrolls and jobless claims. At the same time, US housing statistics, industrial production, and other macro data also suggested the economic growth is slowing down. Thus, instead of rate hiking, the market discussions are centered on rate cuts in 2024 at the moment. As a result, the US dollar is losing support, dumping hard below its 200-day moving average yesterday to new low last seen in late August. The dovish November FOMC meeting is obviously not helping, given the equity market is going up sharply, with NASDAQ 100 eventually breaching 16,000 and recording a year-to-date high. The attraction of US dollar diminishes with lower dollar index and less hedging needs against stock. Meanwhile, the conclusion of the rate hiking cycle also boosted the US Treasuries, especially at the long end. The 10-year yield has dropped around 62 basis points from the local high in late October to 4.4%-ish, while the magnitude of the rate decrease in 30-year is about the same. In this case, the opportunity cost of holding gold is decreasing at the moment, and in the longer term, we can find the 2-year, 10-year spread is dropping as well, which means people are asking for less compensation for holding treasury with longer maturity. In other words, the inflation expectation is decreasing, which is another factor boosting the gold price. Last but not least, silver is pricing 100 basis point rate cuts next year. The real rate also decreased to 2.1% or so from 2.6% in late October. These factors all help gold prices. So in summary, gold is catching the uptrend very well at the moment, with the market expected the rate hiking has ended as the macro backdrop, the weak US dollar, the lower US Treasury yields, the punchy rate cuts being priced in, and the soft real rate all contribute to the gold rally. For the remainder of this year, traders should closely monitor any negatively skewed economic data or any unexpected changes in the information flow, which might indicate more aggressive rate cuts next year and thus boost the gold price. So that's all for this week. Stay tuned with Pepperstone for more insights and also updates. And until then, happy trading!